Our main focus point on InvestTalk today is about passive investing, which started in the 1970s by Jack Bogle from Vanguard. And it is described by being a market cap weighted strategy, investing more in the larger companies, less in the smaller companies, but the same set of companies, S&P 500. Problem is that now passive flows dominate. 53% of all flows into the markets are passive. That means more and more money is being put into markets without any understanding of valuation, fundamentals, etc. It's just which companies are worth more, which companies are worth less. That's it. And what this has done is increased correlation across the markets. So companies with very different business models are moving together, mainly because they're a part of the same index. So this has diminished diversification for most investors and eroded the most important part of capital markets, which is price discovery. Now, if you go back and look at the time between 1995 and 2005, and you look at the S&P 500, it did well, earned 11.4%. So this is in the midst of, before really the run up to the dot-com bust and then the bust, right, in 2005. And that's before we had really the financial crisis, which started, we peaked in 2005 and then we went lower. But over that period, through that cycle, the Russell 1000 Value Index actually returned 13.2%. So an index that actually focused on fundamentals did better through the cycle, through the up and the down cycle. And then the equally weighted S&P 500, which is all the same stocks, just equally weighted, not putting more money towards those larger names, right? And rebalancing on a regular basis. That actually returned 13.6%, over 2.2% per year, more than the broad S&P, the market cap weighted S&P. And so what that shows you is that those within the regulatory agencies and Vanguard and BlackRock, all these companies that run these market cap weighted indices, they're misguided and they're not guiding you correctly. And you should be investing in maybe not active management, but at least indexes that are focused on fundamentals, focused on being more neutral, right? Equally weighted. And that's the direction at least every investor should be headed, and away from these market cap weighted indexes.